Hey there, this lecture is on risk management. Some say that risk management is the holy grail in Forex trading. I know in an earlier lecture I said the holy grail is the disciplined trader. Well, to be a disciplined trader, you must use risk management. Here are some pointers about risk management to remember while you're trading. The first is to avoid or minimize losses so you can stay in the game. If your account is blown, then you won't be trading anymore. Most beginners blow one or two accounts. I have myself. I know many successful traders who have when they first started out. It's not a big deal. Just remember to keep your initial account small because there's a high likelihood that it's going to get blown out. Now, why would it get blown out? Because beginners tend to not take risk management seriously. You have to remember that drawdowns will happen. A drawdown is the high that your account size goes to and then the amount that it drops from that high. That's called a drawdown. Another reason that they fail is because the trader increases his risk or doesn't understand how risk works. Maybe he took a bad trade and then he wants to make it up by doubling on the next trade. One way to avoid this is to treat your small account as if it were a big account. We went over this in one of the introductory lectures, but if you have a $1,000 account or even a $500 account, just multiply that by 1,000. Say it's a $500,000 account. And then you won't be risking 20-30% per trade. Another reason new traders fail in the risk management area is they don't use the proper risk reward ratios. Now, depending on the strategy, but this applies to most strategies, you want your reward to be higher than your risk. Say 1-to-1 would be the minimum, 2-to-1 would be good, 3-to-1 would be even better. But that's hard to attain. Or do something like once it's 1-to-1, then move your stop loss to break even. Let it go to 2-to-1, close out your trade. Another thing to remember is that risk to reward ratios are more important than profit and loss ratios. Beginners tend to focus on profit and loss ratios. They say, well, I won 90% of my trades. Or they say, I won 70% of my trades. And then the successful trader comes along, he says, well, I won only 40% of my trades. Except this successful guy made 3 times as much as the other guy. How is that possible? It's possible because of his risk-reward ratio, not his profit-loss ratio. Another way beginners blow their account is they cut their winners short and they let their losses run, hoping that it'll turn around. Eventually, it turns into a bigger loss, and they eventually close it out at a much larger loss than when they initially wanted it. The opposite of that is what we want to achieve. We want to let our winners run and cut our losses short. Now, on the second infographic, risk management is broken up into 2 sections, leverage and position size. Leverage is the amount of margin provided by your broker. 2% margin is standard for US accounts. 1% or even less than that is standard for other countries. But professional traders don't utilize all of this margin. Some even use 50%, which is not much leverage at all, considering how much is available. One thing to keep in mind is once you're confident in your strategies and your systems, then you can start increasing the leverage. But until you get to that point, don't use all the leverage that's available to you. Position size, that is the amount of units that you're trading. Say a $10,000 trade would be 10,000 units used. That would be 1 mini lot or 0.1 standard lot. You don't have to do these calculations manually. I have included a resource for you guys to use. Go to the website finance-fantasy.com. Go to the post called Forex Risk Management Tools. Once there, just scroll down to the bottom until you see Position Size Calculator. How to use this is you put the currency that your account is in, and then your account balance, the amount of risk that you want to take on that trade, that can be toggled to the amount of cash that you want to risk, but let's leave it at percentage for now. To toggle it, just click that little circle there. And the amount of your stop loss, say for example 50, 25, 20, 10, and then calculate, and it gives you all the numbers here. It tells you what size of the trade you should take, how much cash you're going to have at risk. It's a good tool to use it on all your trades. That's it for risk management. On the next lecture, we're going to go over stop losses. See you there.